Indian equities, the road ahead. We've heard very initial introductions about a panel, but if ever, and that's my firm belief, if ever a pantheon of great investors on Dalal Street is to be made, there are three names which will always lie on that pedestal in that pantheon. It has to be Raamdeo Agrawal, Madhusudan Kela, and Bharat Shah. Not only are they notable investors, they have mastered the art of creating wealth for others. It's legendary what Mr. Shah has managed to achieve. He was amongst the first in 2000, early 1997-98 to identify the CRAMS opportunity, the India IT opportunity. Madhusudan Kela, the fund he used to manage early, Reliance Growth, and hear me out, I've checked the data twice, has given a return of 80x. It's an enviable return. Even Berkshire Hathaway has not given this much in only 19 years. 80x in 19 years, all of us understand numbers, do your maths, that's the return which Reliance Growth as a fund has given, and that's the power of equities. Raamdeo Agrawal, he's legendary. If you ever walk on Dalal Street, he can give complex to Shah Rukh Khan there because people worship him on Dalal Street. He's made some investments in Hero Honda, and I'm sure he'll enlighten us with some more. So that's the just whole take on the kind of wealth and the kind of knowledge and the kind of experience today's panel has. And Bharat, everyone knows that equity is the best asset class. We have an intelligent audience here. Everyone knows the power of compounding. They need no introduction to that. But everyone here is underinvested in equities and overinvested in other asset classes. Why is that happening? It's sad it's happening, but it's true.
First and foremost, because people are so obsessed with the short run, even if that is shallow, at the expense of a long term, which may look like really long term and uncertain, but which has far deeper implications on the wealth. And people just get like a mincemeat carried away between the two. Thirdly, I think a fundamental intolerance for a short-term quotational ups and downs of the price is what deters people from participating in the equity as an asset class. I can reasonably safely say, and I do not want to sound overbearing, but if you follow your work well, you choose well with discipline and character, you value the businesses properly and act upon that understanding of the value by buying at a margin of safety a good business run by good people, and then you have a wisdom to stay the course. I think it is impossible over a long run to lose money in equities. You just cannot lose money in equities. You have to actually work hard to lose money in equities. And while I manage both fixed income and equity, so I have a reasonable ringside view of both the arena. While fixed income, from a psychological perspective, gives you a comfort of not losing or not surrendering when the times are yo-yoing and difficult ones. Best of the fixed income returns are unlikely to match on a long run with relatively mediocre kind of an equity return. So there it goes. But the intolerance to put up and bear with the volatility in the short run is something that deters people enormously. And one final point I'll say, most of the other asset classes are such where without too much help from others you can still participate. It doesn't require too much of a skill to buy a fixed deposit of a bank or even to buy income fund of a mutual fund. To buy a real estate piece oneself also, one can do it on a general common sense basis and can do that. But equity is not DIY or do-it-yourself scheme. It does require some specialized knowledge. It requires, more importantly, a temperament, and it requires a certain character. And unless one can bring to bear upon all of that in equity investing, equity then is a monster. Because you don't, in a bad investment in equity, you don't lose 5-10% or you don't make mediocre returns. You can end up losing 50, 80, 100% of the money. And because it is that kind of a ferocity if it is done badly, and because it requires a specialized knowledge which unfortunately not too many are either willing to invest into or may have temperament to do, when they throw the dart, which is what they end up doing when they pick up these stocks, the results are pretty depressing ones. And that in turn becomes a psychological image of equity as a bad asset class or a difficult asset class, rather than really their own mindset and the attitude. But as I mentioned earlier, when done with character, in other words, when you identify good businesses and you have reasonable amount of felicity to understand the good from the bad, when you have a skill to value a business and you act on that to buy with a discipline only quality, and that too at some margin of safety, and then you have a wisdom to stay the course for long enough period of time for all of it to unravel, it is impossible to lose money in equity.
India has 33 crores Devi and Devtas, like we say. The problem is that we only remember God, we don't touch equities here. Why is that an average Indian is so underinvested in equities? You know, foreigners, they love India, they are investing in India from many years now, and we Indians don't believe in what is, standing in front of us.
We have been, if as an individual, if I say what is my biggest disappointment, it is that in spite of consistently trying for last 13 years, we have not been able to convince our own people to invest money in equities. And I think, these kind of forums, though we do not get anything instantaneously, but we do this only to increase the conviction of people who want to invest in equities. And we have been very bold, in whether it was a crash of 2008 or beginning of 2003-04, laying down that this is one asset class which is really going to give you a much superior compounding return than any other asset class can give you, and it is tax free. People miss this point that in India all the business people who are sitting here, if they're making 100 rupees, they pay 35 rupees tax. If Kela makes money on a single stock, if he has to hold for 1 year, it is tax free. So people have not appreciated, and as Bharat Bhai put, I just like to repeat 2 points. In my view, it is just lack of doing that basic work which is required. आप अपने धंधे में 24 घंटा बिताते हो. How many people would have even tried to reach me saying that साहब आपने वहाँ पे जाके बोला नहीं समझा, एक आधी घंटा आप one on one आके समझा दो. People don't want to do that homework, and that is where I don't agree with Bharat Bhai one point, that it is very hard to find an instrument to invest in equities. We have there are so many funds now have a track record of 5 years, 10 years, 15 years. You don't have to do anything. We just have to see that he is the most stable investor and he has performed good times, bad times, Kargil war, oil going to $150, US economy going into recession, Iran-Iraq war. Every time through this time period, this person has performed. And you just have to go and bet on him. And it is so cheap. आपको लॉन्ग टर्म टैक्स फ्री पैसा मिलता है, 2% में मैनेजर मिलता है. What more can you ask for? So I think it is just the lack of conviction and the homework which you have to do. And third is, जब आप कोई घर लेते हो, जब आप कोई सोना लेते हो, जब आप फिक्स डिपॉजिट करते हो, do you go and ask your real estate agent every 3 months कि भाई मैंने घर लिया था, प्लॉट लिया था, अभी क्या भाव है? You don't ask. But equity में 5% गया, कोई भी रीजन से, बोला ये मधु केला भाषण बहुत देके गया, देखो 5% डुबा दिया. But you not willing to give me even 1 week or 2 week or 5 week or 2 months, and then you are comparing कि उसने 2% ज्यादा कमाया ये पीरियड में, इसने 2% कम कमाया. अरे भाई, as an asset class, if you had an adequate allocation to equity and if someone compounded at 18%, 20% or 22%, still 18% compounding is not happening in your portfolio in most of the other asset classes. So this is the thing, is that if you take a long horizon, which is very difficult because people by nature have got into ये घटेगा तो लेंगे, correction आएगा तो लेंगे. I think when you buy a real estate, you don't apply the same mind. I don't apply the same mind when I go to make a deposit in a bank. You don't say that when interest rates will rise, I'm going to put money in the bank. You go and whatever the interest rate is, you go and put that money in the bank. So if you have a horizon, friends, I am telling you, we cannot do anything about 10 years back, 5 years back, 2 years back. We can't even do anything about what happened yesterday. But what lies ahead of us over the next 10 years, those of you who have missed this opportunity, and if there is a correction, and we will talk in greater detail that if there could be a correction, I think don't wait for that one single point to invest all your money. Be systematic, make sure that there is a particular allocation to your equity, what you can digest for over the next 5-year and 10-year time frame. And I think there is still a lot of wealth to be created.
I'll just say the point too. He said that it is difficult to find managers. That's not what I say. I said that when you do it yourselves, DIY, finding, unless you have the temperament and the skill to do so, chances are that you will end up with the dud ones.
Yeah,
so I was not talking about finding managers.
Why do it yourself? Because
that is a separate issue.
when you fall sick, you don't want to cure yourself.
No,
when your tax return goes, you don't want to go to the income tax authority yourself. You rely on a chartered accountant, you rely on a doctor. For every profession, you rely on some professional. And I am saying there are list of established fund houses and there are list of established professionals who have proven to them over cycles for the last 10-15 years. So that finding that is not difficult. So trying to do it on your own without understanding the subject is only going to get bad results.
I didn't say that because that would have sounded like our self-advertisement.
See, Buffett once said that never ask a barber if you need a haircut. He will always say yes. So fund managers will always make a case that equity as an asset class should do well. But Raamdeo,
that's correct.
जब जागो तब सवेरा. अब यहाँ लोग जाग रहे हैं. जब जाग चुके हैं तो दौड़ना चाहिए. So my question to you is, what is the case for equities to do well in the next 3 to 5 years? What is the core belief? Is it Modi Sarkar? Is it the India story? Is it demographics? Or is it only tax advantage?
Equity investing is not about the slogans, जैसे मोदी सरकार का भी नया है कि साल एक शुरुआत अनेक. So investing is far more serious, and investing is about investing in the entrepreneurship of the country. When you buy 100 shares of Reliance, when you buy 100 shares of Telco, what you are saying is that this company is making today 2,000 crores and in next 10 years it is going to make 1 lakh crores. 10th year it is going to make 20,000 crores. Reliance used to make 2,000 crores in 2003 and in 2013 they made 20,000 crores. That's the call you are making today. And that has, see, in 10 years, all of you are businessmen, everybody will have a tough time. Sometime it will be a fast economy. Between 2003 and 2013, we have seen 2003 to 2007, one of the biggest expansion in the world economy itself, forget about Indian economy. Then we have seen the biggest collapse from which psychologically nobody has come out from between 2008 and 2015. So you will get this, yet the companies are making money. And it is entrepreneur's job to take care of all the adversities and make money. So you are investing in that entrepreneur, and hence it doesn't require any time. What is right time? Whenever you have the money, that's the time to buy. So you don't bother about correction. Don't time the market. The guys who have timed the market, they are still timing the market. It is not about when you buy, how much you buy, how long you miss it. Because 10-year story will happen in 10 years. It is not going to happen in 10 months.
It's about what you buy. It's not about when you buy.
Yeah, so that's where you need expertise. Funny thing about equity market is, like you go to a gold market, you go anywhere, you get 24 karat gold. So you get the same gold. In equity markets, you get minus 24 karat and you get plus 48 karat. And lower the carat, higher is the shine. 5,000 companies are there, hardly 4,000 companies junk. Investable companies are not even 1,000, I am telling you. But it is very difficult for people who are busy in their own businesses to figure out which ones are good. Because time is friend of good companies and equally big enemy of bad companies. A lot of people, they have very uneven experience investing in Indian markets. Because Indian markets are cyclical. You have first bull run in 85, second bull run 92, third bull run 2000, fourth bull run 2007. Now fifth one is in making. So what happens is people come at the top of the market. They get very confident to invest in Indian equities, at top of the cycle. And they come there and market collapses. They have bad experience. So they get scared. And then next time they don't come. Their allocations go drop. I'm quite sure in this audience, everybody must have had a bad experience. And that has driven them to another asset class, which is real estate. And because of demographics of India, real estate has done wonderfully well. So why should we say that they have done a bad allocation? They're smart guys. They're businessmen. And they've done very well. Go and ask how well they've done in real estate. They're stuck with the liquidity right now. That's fine. But basically they've done very well. So it's not that, and equities are not done very well for last 5 years. So I think on the whole, they would have done very well. And as the equities start doing well, they'll all come in hordes. I'm quite sure that next time we come, the hall will be 2 times bigger packed.
Every bull market has a theme. The last bull market in 2003-2008 was a commodity and infrastructure bull market. If you bought HUL, you didn't make money. And similarly in this bull market, if you bought infra companies, you're not making money. So Raamdeo, I'm not going to get into quality versus junk. My question to you is that let's look at the big triggers for next 3 years, which are staring at us, whether it's interest rate cuts or earning expansion or recovery in the infrastructure sector or revival of the banking sector. Give me some 2 or 3 things which make you optimistic, which could be a big themes or which could be a big ideas.
So what makes me very bullish about Indian story is the way we call it, India the next $1 trillion opportunity. So what happens is that India is passing through that unique phase of per capita consumption, which is growing very rapidly, discretionary spend. So it took 60 years for the country to become a $1 trillion economy in 2007-8. So that is $1,000 per capita. And in that, your discretionary spend was just about $100, $50, $100, very thin. And it was all essential thing where there was no corporate activity. So you can't make money out of that. Now in next 4, 5 years, 6 years, this year is the year of $2 trillion. Now your per capita GDP is more like 1,500, 1,600, 1,700. So what happens is when your GDP doubles, which is a very normal 7.5% kind of situation. Your dollar GDP growth incidentally is going about more like 10%. Nobody talks about it, but that's the real global GDP purchasing power. Your dollar GDP has grown at about 10% despite devaluation. And that's how you are in less than 7 years, you are at $2 trillion. If you are in 2007, you are at 1 trillion, today you are at 2 trillion, clearly it has grown at about 10% compounded. So that's the dollar GDP growth rate. That gives you global purchasing power. Now what happens is that your per capita income has gone from say 1,000 to 1,500, 1,600. So your discretionary spend has gone from $100 to $600. So what is a doubling of GDP is 6 times for the businesses which are catering to discretionary spend. Look at all the companies which are in discretionaries, whether it is a page industry, whether it is Eicher with a motorcycle, whether it is food, and whole lot of companies, they are doing very well. So the discretionary spend, China was a $1 trillion economy in 1998. You see what has happened. We didn't know where China is in 1998. Today it's all over China. There is no discussion, macro, micro, global economy without China being mentioned. Same is the story going to happen for India. We are just 10 years behind. Maybe with Modi government we might do it for 9 years, and if he also doesn't do well, it might be 12 years. But this story is bound to happen. India,
nothing can go wrong. Are you saying that?
Nothing can go wrong. There is very little probability. See, this doesn't mean that you will make, as Bharat said, I mean, nobody has given you some, kind of a guarantee that you will make money here. You have to earn your money. You have to buy the right stock. You have to put your bets at the right places. And if you can't do it yourself, please choose a manager who can do it. Who can figure out difference between a bad company and a good company, a bad business and good business, good management and bad management. When a terrific business is run by terrific management, 10x business is run by 10x management, you get 100x. You don't get 20x. It is not 10 plus 20. It is 10 into 10. What is Infosys? There were hundreds of companies in 93. Everybody had the same client, same cost structure, same opportunities, same momentum. Only 4 companies are left. Infosys, Wipro, TCS and SCLT. Where are those other companies? They are all there. All registered offices in Hyderabad, Bangalore, Mumbai, Gurgaon, all over. But they are gone. Only those 4-5 top managements, they stayed. So the real differentiator for long term making money is the great management. So you have the underlying belt which is happening, every minute it is happening. Businessman doesn't know what is hitting them in terms of opportunity. You know, somebody is up 100x. Look at the companies. They're up 100x in last 10 years, even in this bad time. They're growing, they can't supply the demand. This is the last large market for cars. We do 2.5 million cars in a year. China does 20 million. After 10 years, if by chance you do 20 million, what happens? You know? So the opportunity is massive.
Investing is very simple. We just make it very complicated. Equity investing is only about finding a good business which fundamentally has a character to create both a growth, a reasonable growth over long run.
If investing is so simple, why do you charge 2%?
That's the right.
A good question, and I'll answer that once I finish this part. Investing is only about finding those good businesses which fundamentally have a character to get bigger and to do it in a sensible, profitable way so that economic value will be created, and also ensuring that these good businesses are run by people of integrity and capability. And the final task you as an investor do have is to buy it at a sensible price, because you don't want to buy silver at gold's price. You want to probably do the other way around. It is this which is investing, trying to predict a market level, trying to predict the next new move by Fed Reserve in America, trying to figure out all the nice sounding sound bites about global macros and Indian macros, or trying to find next new big wave, you know, that now this sector or these idea will be a next new wave. All these are actually ways of kidding around with our own simple, uncluttered task of finding good businesses run by good people at a sensible price. This is what investing is about. But if you want to cloud it and confuse it with hundreds of other things, this is where then it adds, as Raamdeo ji mentioned, it is that 1 in 99. The 99 has no potential to give anything, but it sounds so very attractive to talk about and discuss about. 1% is simple, right there, available, but yet it is trifled with as if it doesn't matter. Ye ghar ki murgi dal barobar types.
Nikunj, can I ask Bharat bhai one question on your behalf?
Yes, please.
Bharat bhai, how do you deal with this philosophy? How do you deal with a situation like 2008-9? When you say that you don't bother about what is happening in the global markets, what is happening to the macros, and suddenly you see market collapsing by 40% for something which you didn't even know that it is coming, and it came from macro, and in that period, if I am not mistaken, we can go and check, all the quality companies also fell by 30, 40, 50% when the index itself was down. So if you say that you don't bother about it and you just buy businesses, how does this two matches?
Right. Very good question.
I am asking on behalf of Nikunj and maybe on behalf of
I
audience.
appreciate, I understand that that is what it,
questions.
Yeah.
the one that you asked before, I'll answer that. No, I think what Madhu has raised is a very, very vital issue. Time to time, events will come which will overshadow the merits. I'm not saying the events of 2008 variety will come time to time, because if markets start losing some 65% every few 5, 6, 7 years, then I think we all will run away from the markets. But fortunately, such cataclysmic events occur once in a while, once probably in 50, 60, 100 years, and it doesn't happen like a normal occurrence that markets lose some 60, 65% in a relatively brief period in a sledgehammer way. So fortunately, such events are fewer. Second, whatever you may engage with, you still, it comes back to that unknowable category what Raamdeo ji talked about. Do you really have a serious chance of being able to say that such an event is lurking around and like a freak thing, it will hit and it will destroy. So I do not have any capability to make a very bright prediction about such events as they lurk around in the corner. So I must admit my own completely foolish ability to judge this kind of things on a perfect predictive basis. Third, even if such events occur, you think about it, the event like 2008 did occur. But then there are plenty of businesses which are still sitting at 5 times from that previous peak price, 7 times, 10 times, and some others are at half, 1/4, and 1/10 of those prices. So markets have still, they gave you a shock. They impacted you badly at that point of time. If you surrendered and threw away everything, baby with the bathwater, then the outcome was terrible.
I have a limitation because time is just not on my side. So let's put our hands together for this lovely panel. They've been very enlightening and they've been very kind, all that have come to Bombay and help you understand the future of India.